Welcome to yCITIES Inside the Mind of an Investor series. yCITIES cultivates an intergenerational entrepreneurial ecosystem for middle schoolers and beyond, supporting a diverse pipeline of tomorrow's founders and investors. Angel investors are a vital part of the startup community, and while there are plenty of resources about how to pitch or how the process works, it can seem like a black box as to why an investor chooses to invest, not only to founders, but also to peer investors. So we decided that we wanted to have many conversations with many different investors and to focus on one investor at a time. Every interview is anchored by the same 4 questions, but each conversation is shaped through follow-up questions influenced from the different lenses of our panel of hosts. So today I'm super excited to introduce our guest investor. Welcome, Tasha.
Thank you for having me. I'm excited to be here.
We're excited to have you, Tasha. Can you start off with telling us a little bit about yourself? Can you share with us kind of your thesis for investment, your way of kind of thinking about risk and all the goodness? And we know that you're both on a personal individual investor as well as a by day an investor. Can you tell us a little bit about the nuances of your existence in living in those two worlds?
Yeah. So I'll back up and share a little bit about my personal story, just because I think it provides some interesting background into how I found investing and how I started working with startups and why it was interesting to me. So I grew up with a mom who had worked in book publishing. So she was very much like deeply steeped in the humanities and how to think and write about the world. And my dad was a technologist. He was an early employee at Microsoft. And so he was very technical. He understood how to code and how computers worked. So I grew up in a family where we were always merging writing and reading and research with thinking about technology and innovation and how it shaped our world. And so that colored a lot of my experiences growing up. And I think it has really impacted my interest in working with startups and specifically being an investor, because I feel like a lot about being a professional investor and also being an angel investor and working with and advising companies in my free time allows me to merge those things together. I consider myself to be a very research-driven investor. It's just my style. Different investors have different styles. But I think it goes back to having that background. So I, in particular, am very interested in consumer products, whether that's consumer software, applications, games, or physical products that you can hold and use in your everyday life. And when I think about researching those spaces, I care a lot about what trends are happening, what is affecting consumer behavior. There's some interesting psychology to it, but it's essentially just like, how are people spending their time? What matters? I spend a lot of time thinking about online culture. And so that informs kind of the spaces that I'm interested in investing in and the companies that I find interesting. So hopefully that background is helpful a little bit to frame how I got excited about it and a little bit about how I think about the space.
What led you to consumer?
I have always been fascinated by it. I think it's hard to explain, but growing up, I was really fascinated by why people do the things they do. Why do you want to wear Nike sneakers instead of Adidas sneakers? Why does that resonate with you? Why do people want to use social networks? What keeps them coming back when you sign up for something once? What makes you come back and make another purchase? I also have a background in art history, which in some ways is not relevant to being an investor, but I think that interest in culture and how things look and why that resonates with people actually does have some overlap with thinking about the consumer space. It's very visual. People make decisions for a lot of reasons on why they buy products, but actually the way that things look has a huge impact on why people buy products and how they think about creating their identity and how it shapes the way that they move through the world. And so I think when I realized that you could be a consumer investor, I didn't even realize for a long time, I thought it would always be a hobby, that I would just follow consumer trends in my free time. But when I realized that it could be a job, it felt like the perfect fit. Was kind of this realization moment for me where I discovered, wow, all the interests that I had growing up and I built them over time, this could actually be my job, and I can like put rigor into this, and I can be thinking about it in a very serious way. And yeah, that's kind of like how I found it. It is a little bit niche, but it was really exciting for me to discover that it was something that I was interested in.
Are there any particular consumer trends that you're interested in right now, that you're looking at right now?
Yes, there are a bunch. I've been spending a lot of time in crypto and something called Web3 recently, and I am really fascinated by how crypto is shaping the world that we live in, whether it's touching the video games that people play or the way that they pay for goods and services online or in real life. I'm really interested in something called NFTs, which is kind of like a way to authenticate something digitally. And you can make any kind of an asset in NFT and buy and sell it online. And I feel like we're at an interesting moment where things in the crypto ecosystem are affecting consumer behavior a lot. So I've been really excited about that. I'm also really interested in consumer products that have a sustainability angle that can move the needle, whether it's working with products that are more sustainably sourced or recycled, platforms that enable a circular economy. Like a company like Depop is really interesting, and there are a lot of startups that are building similar models. Yeah, so those are two spaces that I am personally very excited about.
That's very cool. When you're looking at different consumer startup pitch decks, what makes you pause and be like, okay, this is going to be the next social media, the next crypto, or next blockchain that is really going to make it versus another one? Coming from the deep tech hardware space, a lot of times to me, consumer products seem too similar for me to be able to distinguish like what's going to make it versus what's not. How do you go through that process with your research? Like what types of things do you look for that the company's doing? And also what are you looking at when consumers are buying? And I would love to hear, I know this is sort of a two-part long question, but what were you looking at pre-COVID versus current COVID because of the trends of a lot of people either buying more stuff because they were stuck at home or not having the income to buy as well?
When I'm looking at companies, and especially the companies that I'm investing in, like from a personal perspective, or even once like I don't have infinite amounts of capital, so I don't always write a check, but sometimes I just like work closely with companies and advise them, which is a way that I can have exposure without actually having to write a check myself. One, I'm very interested in the founders, especially the earlier stage the company is. Do the founders have a unique insight into the problem that they're solving? People call that founder market fit. And like, have they had a lived experience that really resonates, that gives them unique insight into the product that they're building? Are they really motivated to do what they're doing? If you're going to invest in a company, it could take a decade or longer for that company to exit, whether they're acquired by a larger company or in an amazing scenario, they go public and they have an IPO. And so you really need to be dedicated to that kind of idea. I feel like you can tell when you speak to somebody about their venture that they're working on. You start to get the sense if this is something that they really want to do for the next decade, or if this is an idea that they're just excited for now. And there's nothing wrong with working on an idea that you only feel excited about doing for the next 2 years. But I think that's where I draw the line personally, where I think if I am considering really making an investment of my own time and capital, I want to be aligned with somebody who also is thinking about the long term. I feel like there's another part of the question, which I'm not.
Pre-COVID versus post-COVID consumer trends.
I feel like post-COVID, it has affected consumers' behavior a lot. It's interesting. It remains to be seen whether that's a temporary change or a long-term change. Like a good example of that is Peloton, at-home bike company, had an amazing surge through COVID, and their stock has performed very poorly recently. And it's raising questions about all of at-home fitness and whether that's really a long-term trend or that was a temporary bump from the pandemic. I personally think it's probably a combination of the two, and that it's not the whole future, but there's a bigger market for at-home fitness than there was before COVID. But I do think it made a lot of consumers reevaluate how they want to spend their time and their money. More people are spending time at home, for example. Not everybody's working remotely, but enough people are, and that has caused a huge boom in home goods, for example. Like cookware companies have done really well, furniture companies have done really well because everybody is upgrading their spaces. I feel like that's an enduring trend. I don't think that people are going to move away from valuing the spaces that they live in, for example. And as people spend more time at home and engage with their families, I think it has affected the way that people think about their digital screen time as well. More and more people are spending time on social media and video games. I'm excited about that, but I'm also feel like I have a very high bar of if people are spending time digitally, it needs to be an authentic platform that is creating a safe space, and not all platforms are doing that. And so it's something I've noticed post-COVID is that consumers want to be on healthier platforms, like in digital spaces. And so as an investor, I've been thinking about that as well.
You like
Deepak?
early stage. You mentioned very early stage, right? And so you're those are the higher risk ones. And you also mentioned the kind of lived through experience, founder fit. How much does so I guess I have a two-part question. One is, and you also mentioned that you get to know the founders through mentoring. How as a part-time investor, because you have a day job, not as an angel investor, how do you decide which founders to mentor? And do you, kind of related to what Isabelle was asking though, like what kind of pops out that makes you decide that? And is because a lot of other investors that we've talked to have mentioned like potential for the exit, which I didn't hear you mention, which doesn't mean that that's not a factor for you, but I was just trying to gauge sort of in your own kind of prioritization in your mind, where does that fall into, especially since you like very, very early stage where there still might be formulating a lot of these things, right?
Yeah. I think one of the things which I mentioned before is that I am a younger person. I don't have insane amounts of capital, and so I can't write large checks. I think when you're in that position, sometimes you have to prove to a founder that you're valuable to include, especially if it's a competitive financing or it's a hot company. They have choices of who can be on their cap table and who they want to be working with. Sometimes, like, I feel like I personally can't commit capital, or I'm not quite sure about a company, and it's a really big deal for me to say, okay, I want to make an angel investment. And so I might try to work with a founder and give them some advice and try to be helpful, which is proving to them, okay, Tasha is actually useful. If she asked if she could invest in the future, we already have that relationship. It's more likely that they would say yes. And also it allows me to have exposure, and I can work with them a little bit and see how they operate and how they think more closely. And so it just gives me a little bit more time where the next time that they fundraise, I could say, would you be open to having me as a very, very small part of your round? And they might be more likely to say yes. I think because I, like, in my personal time, have been working with very early stage founders, like founders that have raised a little bit of friends and family money. Thinking about the exit is so far off. It's so far in the future. And for my own personal risk tolerance, basically, if I decide to write an angel check, I write it off to zero. Like, in my brain, I tell myself, like, I'm gonna get it back. Of course, I like fully believe in the founders and their ability to build a company and one day like have it acquired or go public. Like, but I think like how I need to structure my own mental model is like thinking about like, this is essentially, it is an investment, but I'm not quite sure if I'm going to get my money back. And working with very early stage startups is very risky. Very few startups make it to that like theoretical end zone. And so for myself, I think I'm less focused on the exits, especially because I'm coming in so early. And like I want it to happen and I want to work with founders to make it happen. But at the same time, I understand the realities of the game of working with early stage startups, and it doesn't always work out. The one other thing I'll say on that is that I feel like the main reason that I do it is probably not to make money. I feel like I have learned a lot from being close to founders. I've never worked at a startup myself, actually. I worked at a traditional company and I work at a venture firm. So I find that there's a lot that I learn from reading their email updates and having coffee and like working on ad hoc projects with them that I wouldn't get otherwise. And so because I'm still early in my career, even if I never make money from the angel investments that I make, I feel like I'm getting something out of it from the learning experience and that exposure, and that is also valuable to me.
Your investments are almost being treated like tuition. You're gating.
Yeah, I mean, I hope that I'll get something back,
Yeah.
But it's a long-term game, and in the meantime, I feel like it's an amazing learning experience.
Yeah, wonderful.
So you mentioned that you work at venture by day. Can you just for on a high level, the difference between investing as a venture capitalist versus an angel, and maybe from a mindset, high level, some of the differences, in the two different hats that you wear?
Yeah, I think there are a few differences. One, probably the biggest difference is where the capital is coming from. If you are working at an institutional venture firm, you may be investing a little bit of your own money if you contribute your money into the fund that you're investing out of, but the majority of that capital is coming from other people who are trusting you to go and invest it on their behalf. So that's a lot of pressure, and it's a really big responsibility. If you are investing your own capital, it's just your capital on the line. And I think that can affect the way you think about risks and rewards and what you might be willing to do. There are definitely angel investors that have very strict kind of portfolio strategies, but what I have found is that angel investors are usually more flexible. So a lot of institutional venture funds have a very strictly defined strategy where they only invest in a specific sector, they only invest in specific stages of companies, they want to have a certain ownership target. Whereas I feel like angel investors are oftentimes more flexible, where they might invest across different sectors that they find interesting. They might invest at different stages. They don't necessarily have an ownership target that they feel like they need to achieve in a company. This is not always the case, but a lot of times if you're investing at a venture firm, you are working on a team. Whereas if you're rating angel investments, that is more of a solo endeavor. Granted, people will pull their money together into angel syndicates and work together. And there are also venture firms where people work by themselves. But I think it's a different mentality of, are you making a decision with a group or are you making a decision by yourself? I am definitely somebody that likes making decisions in a group or with input from other people. So when I have made angel investments or thought about startups from a personal point of view, I really tap into my friends and my network and I'll say, what do you think about this company? Do you want to meet them with me?
Do your friends invest with you? Are they other young angel friends who have a similar kind of thesis and risk tolerance to you?
Yes. I have invested in companies with friends before. Friends will show me companies and be like, I want to invest in this. Do you want to come alongside me? I am part of a syndicate of other Gen Z investors that invest together. So it's a pool of people. You don't have to participate in every deal, but we all get access to the same kinds of very, very early stage opportunities.
Membership to be part of that syndicate?
No, you don't. But the person who organizes it takes economics. And so they will take a small portion of the returns if the companies end up being acquired or exiting in other ways. They have like a reward for being the person that organizes it.
Along the lines of, for the consumer market and the startups that you're seeing, either, I guess you were talking a little bit about the risk tolerance between angel and VC. And that's sort of where in either category, whichever you feel comfortable talking about, in the difference of like, where do you see a company being a good business versus a good investment, right? And I feel like in some ways, you're talking about risk tolerance, that is sort of a little bit of a difference that you can vary on for angel versus VC.
Yeah. There are so many companies that are amazing businesses that I don't feel are good investments. And it's really hard to be in the right bucket of a company that would be an excellent venture investment. The whole model of venture investing is the idea that you are probably going to build a portfolio because it's so risky. And so rather than just backing one company, let's say you back 10 or 30 or 50 or more over time, and you expect that traditionally like 1/3 of those companies are going to be successful. 1/3 might be just like mediocre, like maybe like you don't lose money, but you don't make money. And then 1/3 just go nowhere and like you lose all of your money from that. But you have to have those companies in that top bucket, which are going to compensate for the other 2/3 of the companies that either don't do anything or just completely lose money and go out of business. And so you're expecting that. But if you want a company that's going to be in that top third bucket, they have to have huge potential to grow. Like that company has to be, like it has to have the potential to be a 10x investment. So you could potentially get 10 times the amount of money that you put in or more, because it will make up for the other losses in your portfolio. And so what that looks like in practice is that the company that you're investing in has to have the potential to really scale. So let's say they're doing $1 million in revenue now. They have to have the potential to be working towards $100 million in revenue, eventually $1 billion in revenue. And that is like an insane trajectory. And most companies realistically, like either the founders don't want to scale that big, they just can't, the market isn't big enough. You have to be able to have an addressable market that can meet the scale that the company needs to grow at in order for your investment to be performing well in your portfolio. And so there are a lot of companies that just don't meet those metrics.
So other than the market size, how do you judge the other two factors to make it in the top bucket, given the stage of the startup that you tend to prefer?
Backtracking myself, the market has to be there. I think the founders have to have the willingness to grow the company to be that size.
Well, I guess I was wondering how you measure that.
Yeah, you can measure market size. There's something called a total addressable market. And so you can take the total market size. Let's say I have a sneaker company and I can look at data and see okay, how many people live in the United States? What's the average cost of a sneaker? How many times do people buy new sneakers per year? Okay, people buy sneakers once a year. They're buying sneakers for $100. Based on this many people, I estimate that this is like the total size of sneakers, which this is not true, but just for the example, I'd say sneakers in the US are $1 billion market. I'm making a company that's making women's sneakers in particular, and I'm making like running sneakers. So not just like casual sneakers, but for highly athletic people that want to be racing. So that's a much smaller market than the total sneaker market. So I can size that down and think about, okay, that's my total addressable market. And then I think that I could get 1% of that market. And so that's how you start to think about what the opportunity is. This is the whole market. This is my addressable market. This is the market share that I think that I could have. And you narrow down, and it helps you understand what the potential is. One other thing that I didn't mention about the ability of a company to scale is less determined by the company itself, but more the environment around it. And that's thinking about potential exits. There are certain kinds of companies that are probably more likely to be acquired than to go public. Perhaps they won't be able to reach the scale required to go public, but they could still have a really great outcome being acquired. But it has to be a good environment for them to be acquired. There are certain times, like in history, where companies are being more acquisitive and they're doing more M&A and they're buying companies. In certain sectors, the larger companies are like these big conglomerates, and they are very willing to buy startups. But in other sectors, that activity just doesn't actually happen at all. And so there's certain companies that are in a sector where it's very likely that they'd be acquired. And I think that's great. That gives a lot of potential as an investor for you to feel like you might have a chance at getting a return on your investment. But there are other startups that are in sectors where that kind of acquisition doesn't happen as often. And so it would be a lot harder for you to get a return on your investment. Even if the company is able to scale, they may not be able to sell into a willing buyer. And so as an investor, it's much harder for you to get your money back that way.
So in an industry that's as fickle as consumer products, how do you figure out the longevity of a product? How do you figure out whether this consumer product will last 10, 20 years in the future versus like just disappearing within the year? How do you figure out if basically the product will be able to 10x, 100x sales, or it'll just flop within a year?
Yeah, this is fascinating. I'm actually obsessed with this question, and I've been thinking about it for a long time. I wrote a blog post on this topic, and I specifically looked at Crocs. Crocs is a publicly traded company, so it's not something that you could invest in as an angel investor. I mean, anybody can buy a share of Crocs on the public market, but it's an example of a consumer product that had this amazing ramp up where it was super popular and then it completely fell off. And nobody wanted Crocs anymore. It was completely uncool. And then over the past 5 years, they've been ramping back up again. And their sales and the valuation of the company has followed a similar arc. And I feel like there are a lot of lessons from a company like Crocs that has taken themselves from unpopularity and made themselves popular again. And to an extent, all consumer companies are thinking about the same thing of how do we re-innovate our products? How do we think about marketing? Do we want to align ourselves with certain fashion brands or influencers, things like that? And it takes a lot of work. Like you have to be really up on trends and things like that. I do think it circles back to an earlier point about how important I think founders are, and also to a larger extent the teams that they surround themselves with. Because if you're thinking about trying to be cool and stay up with trends, knowing that your company might be more or less popular over time, you want to have people on your team that are really sharp about that, who are creative thinkers and can think about, how do we do new marketing campaigns? Do we need to test out new kinds of social media? Do we need to release new products? Do we need to redo our design? And some founders or individuals are better at that than other people. There are examples of like exceptional marketers or brand gurus and things like that. And I kind of think it's like a special talent. I don't know if it's something you can really teach to somebody. And so it's something that I look for and try to see, do the people that work for this company or are the founders of this company, do I think that they have that like special secret skill that allows them to understand how trends are moving, what's cool, what's popular, how they can keep innovating and changing?
So this leads me to the question. So between what you just said and then the other one about when you were kind of describing the total addressable market, and then the two other characteristics that make a company be in the top third of your bucket. So old age unfortunately does work against me, is trying to remember what you said on some of those. But one was definitely sort of the market size, or the size of the problem. And then the others, I think, were more along the lines of characteristics of the founder. One was willingness to scale, and then the other one I think was also related to the founder. So that makes me curious, as because there's the two sides of the debate from an investment point of view. If you had to pick one, what tips the scale for you? The size of the market or the founders? right? Is it the horse or the jockey sort of thing for you?
Yeah, it's hard. I think I am probably more biased towards thinking about the business opportunity. And I think it's a personal thing. It's also something I've been thinking about recently of, do I want to adjust my own frameworks as an investor to be more sensitive to founders? Like, I care a lot about the background of founders and their experiences and things like that, but I also feel very focused on the market opportunity and the kind of product that they're building for. I think it depends also on the stage of the business. If it's a more mature company, I'm much more biased towards market opportunity, strength of the product, and also just like fundamentals of the business. Like, you can look at how quickly is it growing, what's their revenue, stuff like that. Earlier stage companies, there is oftentimes no metrics to look at. It can be unclear how big the opportunity actually is. And if they're in the wrong market, founders pivot all the time. There are amazing stories of startups that pivoted. I love the story of how Slack pivoted from a gaming company to be an enterprise like workplace messaging app, which is so fascinating to me. So companies pivot all the time. Good founders are more able to pivot than other founders. Like, it does, I think, take a special kind of skill to be resilient and creative and to think on your feet and execute that. So that's a kind of complicated answer to say that I value founders more at the early stage than at the later stage in terms of how I think their investments, but I am very interested in the business fundamentals and the size of the market.
It's interesting that you kind of raise these points, and certainly, we've heard from investors along the way, as regarding that kind of their ideals about, is it the market size or is it the founder, which is more important? Oftentimes, it's interesting that, a lot of them will lean towards the founding team and talk about the founding team. There's recently a book I read from McKinsey, right? The invisible hand behind most corporations, I like to say, where they talked about, they were looking at enterprises, but I think a lot of it maps back to startups. And they were talking about three things, right? That were super interesting to me. One being just fundamentally the trends in the marketplace. And to some extent, this could speak to what you were saying about the opportunity, right? The size, where things kind of heading and going. The other was the decisions that the management team makes. So this a little bit about, in my mind goes to the founders, right? And their ability to be creative, like how, and testing for, and I got a question for you in this regard, testing for, what is their decision-making approach and model, right? Like, how do you know that these people are going to be making on a day-to-day basis? They may not make, 100% the right decisions, but, that they have a way of thinking that lends itself to continuing to head down the right path while in the cone of uncertainty. And then the third thing being centered around fundamentally the resource, right? Your endowment. How much capital do you have to exercise your decision-making against this trend and opportunity? So going back to founders, I do have a question about, like, how do you test, and maybe it's just a function of looking at past experience, but what are some of the questions or things you want to know about a founder to get you to feel like, I have a sense that these folks are going to be able to kind of think through things with models or methods or logically or maybe at times emotionally, but they're going to land at the right place. How do you get that comfort level that they're the right person, right team for the mission?
Can I ask Shawn if you meant like through her mentoring work, or do you mean like the sense of it as she's like screening at just the pitch level and whether or not to even devote any time to hearing more and getting to know the founder? Or do you mean both?
Right, exactly. The screening, the process of whether it be through, your angel work or your venture work, just kind of thinking a little bit about how do you say, this founder is the one. This team is the team.
This is my personal kind of thought about this, and other people have different beliefs, but I really like to work with founders that I like personally. I think you can probably make a lot of money by working with people you don't like. There are a lot of businesses that have been really valuable that are run by people that I probably wouldn't want to have in my circle of friends, whether I think that they are maybe like not the best manager, or also just like we probably wouldn't get along personally for other reasons. I feel like my time and my capital is limited, and part of the reason why I want to invest in companies or work with them or get to know them is also because I feel like it's an opportunity to make the world a better place and there's an underlying mission. So I do care a lot about founders that I think are guided by a similar set of values and mission to me. And I think the more that I enjoy working with them, the more motivated I am to help them if they need help. Granted, not every founder actually like wants your help, but I think it makes me a more helpful investor because I enjoy working with them. I'm motivated to be with them in the trenches, things like that. I also think it's important on some regard because when you're a startup founder, you need to hire a team around you. You could have an amazing idea, but if people don't like being around you or you're a frustrating person to work with, it will be really hard for you to hire other people to go and execute your vision. And so I think there's something about being charismatic, being empathetic, a strong leader that you can pick up in conversations with somebody on like an actual like diligence and analytical level. You can always have reference calls on somebody. If somebody comes to your network, I will often say, oh, did you meet this person? What did you think about them? I saw that you used to work with them. Like, what was it like when you worked with them together? Did you ever see them go through a challenging experience? How did they work through that? That can be really helpful. So I think like there's ways that you can kind of take a more analytical approach to it, but also you can trust your gut and think about, is this somebody that I really enjoy? And if you don't think that you would at some point in time want to go work for this founder, I think it's hard for me to have conviction as an investor that they would be able to hire a really great team. Like if I'm not sold on their idea enough that I think that I could see myself wanting to go and work for them, that's like the kind of bar that I have. And I recognize it's a really high bar, but I also am not making a tremendous amount of investments. And so the people that I'm supporting, I have a lot of conviction in what they're doing and the kind of person that they are with other people and the way they can build relationships.
And kind of along the same lines of working with a founder that you'd like personally like working with, do you tend to invest more in products that you use personally, consumer products that you're interested in using, or is it just kind of where you see the market opportunity?
At least at this point in time, I feel very much that I don't want to invest in something that I'm not using personally. I just feel like I don't have a good way to evaluate it. And there are lots of amazing products that I don't have a good use for in my life. Either I'm not the right market, I'm too young for it, or I don't live in the right demographic, the right geography, whatever. So yeah, I think one, just like personal interests, limited bandwidth. I want to invest in stuff that is familiar to me. Also, in terms of thinking about doing the research there, I think it's helpful. You can actually test the product. I'm really interested in products that serve Gen Z demographics. It's a little debatable if I'm a Gen Z or millennial, but I probably more identify with being Gen Z. And I think that I actually have a competitive edge there because I'm closer to the demographic that they're working with. So there's probably things I can see there that an investor that's older, for example, might not notice or pick up on. So I've decided to really lean into where I feel like I have strengths and unique insight and focus my time there rather than trying to make up for it in spaces where I don't have that special edge. I definitely could put in more time to get that edge in other places, but I have taken the approach of kind of leaning into my strengths and the things that I'm already more equipped to be learning about and thinking about.
Absolutely. I think it's kind of like the investor version that you earlier mentioned, founder fit, right? So this is investor fit. And this is definitely a place where, I'm a big believer that everybody's an expert in something, regardless of age or, pedigree and, things of that sort. And you're leveraging your life experiences and interests in your life stage as an asset, right? So absolutely. I love it. So that, wraps up this episode of Inside the Mind of an Investor. Thank you so much, Tasha, for joining us today.
Yeah, thank you so much for having me.